And the PMI composites, and this is a domestic composite and this is the global composite, they are a compilation of a great many economic studies that all together comprise the composite. What we see here is, of course, the terrible damage that was done to the economy both domestically and throughout the world in the crisis that was turned around in 2009. And then, of course, the very strong recovery on the back of stimulus huge stimulus in our country and stimulus in most places around the world. And now, unfortunately, despite the stimulus, we have now hooked over. Now, whether that will continue down or somehow if we can get that turning back up again, that's not knowable at the moment. But the direction is clearly going in the wrong. It's going in the wrong direction. Individual foreign PMIs are shown over on page 22. These are some of the bigger countries in the foreign PMI: Japan, South Korea, Germany, Australia, Spain. And you can see they all have a similar pattern. The PMI has turned down after the recovery. Germany, over on the right-hand side, is certainly better than the others because the level is higher. The 50% level is the dividing line between expansion and contraction of the economy. So if it's above 50 but falling, as is the case in Germany, the economy is still growing, albeit at a slower pace because you see it changing down. Once it goes below 50, it is saying that the economy itself is contracting. So we now have a different picture from country to country. The patterns are relatively the same, but Germany is still in the growth stage, whereas the others are down in the below 50 category. And you can see a list on the next page of the first 25 countries that reported their September PMIs, and about 2/3 of them are still growing, but 1/3 of them are now in the contraction phase on this PMI composite. And I think if you see, first of all, that the trend is down and 1/3 of the countries are in a contraction mode, you at least have to say that despite all the very optimistic talk that there's no chance we're going to see a double-dip recession here, on a worldwide basis, if 1/3 of the countries are already declining, and that's the change trend, that is at least a possibility. So I don't think we can preclude the potential that we could be moving back into recessionary territory. Ireland and Greece are among the countries reporting declining economic activity. And the next page shows the market's assessment for the potential for sovereign defaults for these countries and some others. This graph shows how the market evaluates the potential for sovereign defaults. I won't get into the details of it. It's not an easy one to quickly explain. But Greece, Ireland, and Portugal, if you look over here on the right-hand side, are the ones which demand the highest levels of interest. That means they are being appraised as having the greatest potential over a 10-year period of having some kind of sovereign default. And you can see how the risk perceptions peaked in the early part of the year, and then we had the European Union, European Central Bank, and the International Monetary Fund rescue package, which they came out with on a very dramatic announcement, and you see how quickly these numbers came down. What that did was immediately calm the marketplace. They thought, we've got a backstop in case the country is ready to default on its own. And yet, if you look at the period after that initial fall, they're all rising. In fact, some of them are back almost to peak levels, which says that notwithstanding what is being ostensibly promised, there is risk in the perception of market buyers that these countries could still default. And it's important to recognize, too, that this was a coordinated bailout promise. There is no money. This was a promise that we will stand behind failed debt. But as I'm sure any of you who are interested in this subject have read, there is great opposition in some countries, Germany foremost among them. The body politic is not happy about going in and rescuing Greece, as just using that as an example, or anybody else for that matter. And I think that the antipathy to that concept becomes clearer and clearer when you see TV pictures of riots when they can't get the retirement age down to, or if it's threatened to go up to 62 from 60, for example. People look upon that as perhaps freeloading just a little bit. But we will see where that all goes. In our country, there's a strong expectation now that we're going to see QE2, Quantitative Easing, Chapter 2. And the assurance of U.S. stability could fade as well if it is perceived that QE2 is really a recognition that QE1 was either a failure or was at least insufficient. And I think a great many people are acknowledging that, including, I suspect, without quite using the language that way, Ben Bernanke. He has said that this is an extremely difficult time in the economy, and he is worried enough that he is going to throw massive amounts of new money after it, fairly certainly. It now appears very probable that the Fed is going to announce a second QE program at their November 3rd meeting, unless they decide to surprise us some morning when we wake up and turn on CNBC or Bloomberg, and they may do it before, but more likely most people suspect it'll be at the November 3rd meeting. That puts it a day after the election. And there's no way to know whether this will revive consumer confidence. It's certainly already revived investor confidence. When the QE2 almost pledge was made, the market started to improve. Bond yields went down, stock prices went up. We don't know if it'll be successful, but we do know that it will do long-term damage to the dollar. That's inevitable. If you have a dollar and you print another dollar, the first dollar is worth half as much. So if we keep printing lots and lots more dollars, the value of each dollar that already is in existence is going to inevitably become less. Now, the one exception to that would be if enough other countries do the same thing. If everybody starts to devalue their currency, as we're starting to see. We've seen a formal program in Japan, and they've committed to trying to weaken the yen. Nobody wants the strong currency right now. We all want to be able to export. We all want to be able to keep our businesses that have a foreign orientation sending their goods out and getting them purchased overseas. So nobody wants the strong currency. And we've gotten to the point where the Brazilian finance minister just within the last couple of weeks called it a coming currency war. And when you recognize the amount of volume that gets done in currencies when they're moved around the world, I was shocked when I saw the number. Susan Arinsky showed me an article, I've forgotten who the author was, but he was recounting statistically how much goes on in the forex markets, the foreign exchange markets. The entire market value of all the world's stocks turn over in the foreign exchange markets every 9 days. This is a massive market. Now, if you have what is being called a potential currency war, imagine the potential